Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, head of content and programming at Deal Catalyst. Joining me today is Chris Hentemann, founder and CIO of 400 Capital Management. Chris, it is great to meet you virtually. I appreciate your time today. Thanks for joining me. I'm looking forward to this episode.
Likewise, Todd.
I think I'd like to start off, I guess, a little bit, high level in some ways. I guess in today's markets, how would you define asset-backed finance and structured credit in today's market, and how have those definitions evolved, say, over the last decade or so?
Well, clearly, asset-backed finance is definitely very popular. It seems like it's proliferated across a lot of the large platforms that are looking for basically a toehold in sort of the broad ABS credit markets. So it kind of is. If the right word is it's used very ubiquitously, I guess. When I get pressed for basically how we actually think about the market and where we see the participation of other basically managers in the broad asset-backed markets, I always think about basically asset-based finance as really being closer to sort of the lending side of our market. So I guess it basically, just for some simple definitions, I look at credit as actually being a very large market opportunity, as most investors do. Then I just simplify it and say, okay, you've got this very mature, sophisticated corporate credit market. High grade credit and high yield credit has been basically outstanding for decades. You've got basically credit that is actually backed by other forms of basically credit, which is going to finance residential real estate. It's going to finance commercial real estate. It's going to finance consumer receivables or credit cards, autos, unsecured consumer receivables, equipment finance. So those are like the common asset-backed markets. And so asset-backed finance to me is really basically saying, all right, I'm going to basically lend and secure myself in some form against basically an asset that I just mentioned. And so that could be a loan that would actually say, to somebody who put up equity or a haircut, and then they basically make the loan. Structured credit, in my view, is really the next derivative of that. It's then taking that loan, that pass through to sort of concept, and then tranching it into basically sort of different categories. So you just take that simple loan and you create a senior and a junior, and the junior takes the credit risk, and the senior really is in a funding position. They're applying the funding. That's my simple way of describing it, if that was clear.
It was. When it comes to kind of the different players in the market today, obviously banks have kind of the role of banks has evolved, especially since the GFC. You've had the rise of private credit funds, the rise of specialty and fintech lenders. Kind of how has that landscape shifted, and kind of where do you guys fit within the broader landscape?
Yeah, it's a great question. I mean, if you could bear with me, and I mean, it's worth a little bit of historical context. Is I kind of sort of I've been around since 1990 in this space. So I feel like I carry a pretty significant historical view of it. And when I was getting out of school in the late 80s, if you studied anything about credit, you were, the most interesting thing was really the high yield market. And back in the late 80s, there was this concept of this very progressive concept called the junk bond. And Drexel Burnham and Mike Milken really developed basically those markets, and they really institutionalized them, or at least they attempted to institutionalize them. But they expanded the lending capacity for into basically what were really subprime corporate borrowers, if I could call it that. And they were just charging, risk-adjusted rates, which is effectively higher yield than high grade. And Drexel really dominated that, and Mike Milken and his teams basically sort of had the edge. And then we went through the recession in the late 80s, and there were other basically institutional issues, primarily in the banking system, that created a disruption, and obviously put some stress on some of those notes, some of the portfolios, and it goes through a cycle. And some of that actually, I'm simplifying quite a bit, but it came back, and you can see there's a pattern here, is that Drexel actually had certain issues, that actually ended up basically taking Drexel down in the late 80s. And I always think of it as like the Mike Milken diaspora ended up basically sort of knowing basically everything about that market and having an edge on it. And they all basically, created asset management firms around that. And those, they are the Apollo's a great example of it.
Yeah.
And there's plenty of them around. And then since then, that market's become very institutionalized. It's very liquid. The banks have created market making businesses that are massive around it. And obviously you've got everything to speak of since. The asset-backed market really was funded on the bank balance sheets through that entire time. And the banks basically really originated those loans, and then they mostly packaged them through securitizations to basically broker dealers in the market. And that basically happened pretty much in that format. And the banks actually retained most of the junior risk through the late 90s. Glass-Steagall basically started to fade. And then obviously the banks were allowed to basically put more balance sheet up, and obviously they expanded that market quite a bit. Probably also to the same elements, there were certain things that just got sort of beyond sort of the risk that they probably should have taken in those markets. And then you go through the cycle of 2008 and 9, and the exact same element happened in financial history. As you call it, just the similar thing was Lehman and Bear Stearns, and to point to a couple, they had their issues with the structured credit markets, the asset-based finance markets, particularly around subprime lending and consumer spaces. And then after that, you've got basically the advent of platforms kind of that are similar to ourselves. So I'm not sure if I apologize if I may have missed the question, but that's kind of, to me, sort of like, kind of how like the asset-based finance and the structured credit markets have really come through their own evolution. And I think they're just starting to really take off and expand, and the liquidity and the sources of capital are expanding quite quickly today. And in a lot of ways, they're just following the same pattern that the corporate market has, particularly in high yield. And so you've got the convergence of these two markets really in a lot of ways, in terms of the way they're structured, the way they operate. You've got a lot of that happening amongst asset managers. I know we're going to talk about that in terms of just like where do certain managers fit into that ecosystem and how they define themselves.
Would you say it's a healthier balance today than when banks held more of the risk and more on their balance sheets? Is it healthier today that credit funds are kind of have a piece of the market, banks have a piece of the market? It seems to be the risk is spread amongst various players, maybe a bit more evenly than banks seem to have a more consolidated risk back then.
Yeah, so some of my banking friends may not like the answer I'm going to give, but absolutely. I mean, I think it's very self-serving, because we set up a business that actually really was intended to step into that gap and really take advantage of it. But but I also would say, like, I think of like things like what's happened in the housing finance market, particularly around Fannie and Freddie and the credit risk transfer programs. Just as a taxpayer, it's better.
Yeah.
The regulation post GFC effectively told banks and basically Fannie and Freddie that consolidated risk on those balance sheets is not going to be tolerated nor bailed out by the Treasury or the U.S. taxpayer. So it's really opened up the market for credit risk takers in those markets, particularly in housing finance and commercial finance and other forms of consumer and commercial ABS markets. And that's the market that my firm Foreign Capital's in, and we love it. I mean, and the diversification of that risk is actually really good. And so, systemically, you don't have it amongst a few institutions. You've delevered that risk, and so I think the markets are just in such a better position than they were, pre-GFC.
So you mentioned obviously your firm. Tell us a little bit more about kind of who is 400 Capital, and where do you guys fit within the market today?
Yeah, obviously we're a diversified asset manager. We specialize in asset-based finance and structured credit, but we do actually think of it as one complete system. So we do actually look at corporate credit, special situation credit, and CLOs, but tend to actually have a focus and tend to basically get called upon from our client base primarily for our expertise in the asset-based markets. So we've and coincidentally we started as a firm in October of 2008, which is actually very particular timing. So it was just 3 weeks after Lehman filed, and that was somewhat by design because at that point in time, to me it just seemed like such a compelling opportunity, just in the advantage we had coming from basically the banking and the capital market side of the business in that environment. I just felt was not replicable, and we could build a business around it. Needless to say, it wasn't easy. It was a great environment to build an investment management business, but as a capital dependent business model, it was relatively tough. Today what we've done is we've set up a team that actually, which I'm incredibly focused on, has experience that actually does really canvas the asset-based credit markets for decades, pre-GFC most particularly. And I think that's really important. I always remind LPs that it's not just basically having experience through interest rate cycles or credit cycles and saying, oh, I lived through this cycle and this event. I think you also have to have the experience of understanding how the product evolved. And so, like I mentioned to you, like just understanding that perspective of how like the product has evolved over time. Where does it fit into investment portfolios? How well is it understood? What are how is it valued? How are the liquidity markets work around it? Incredibly important, so we've set up teams that actually have really that deep experience, and then we've also have dedicated teams to the individual sectors. So we think of the sectors like residential credit, like commercial real estate credit, like consumer finance credit, in and of themselves, because they're very unique, they're very idiosyncratic. And if to have an edge in that, you have to be dedicated to those sectors, as I like to say, 24/7, 365. You can't be a tourist in those sectors and actually get in front of a new idea, or actually, almost more importantly, is actually exit a sector when you see basically people taking mispriced risk. So anyways, that's our platform in terms of like the evolution, the way we've orientated the teams. We do obviously work with a breadth of investors, mostly on the institutional side. And the way we think about it is that, our mission really is to be a conduit, in my opinion, to investors to the broad, large, idiosyncratic, and consistently return-rich asset-based finance market. Our job is really to basically have a competent team, as I mentioned, to access those opportunities, have the infrastructure, the data, the analytics, the credit modeling to actually do the investment well, and then also have just the vehicles with the right asset liability management structures, which is, I think, sometimes overlooked um, for this type of investing, because what it does bring to an investor is a liquidity premium. But by design, you have to actually, the only way to harvest liquidity premiums prudently is actually do it through vehicles that actually align asset liability risk well. So we do everything from longer term committed capital drawdown vehicles that will focus on, you know, bespoke bilaterally negotiated trades or small syndications of credit risk, all the way through to, you know, high grade liquid forms of the strategy.
Yeah, so one, area, obviously you mentioned the institutional investor piece, and that was one piece we didn't yet touch on. But particularly in today's market, there's this outsized interest from the insurance sector. I'm curious from your perspective, what do you think is driving that demand from insurance companies into the asset-backed or asset-based markets?
Well, I can't represent myself as an expert in the insurance industry. So, you know, it's just flow of capital. So, insurance companies have to bring capital in from premiums. So they're either distributing, you know, sort of insurance products of some form. And there has to be demand for that because the premiums have to come in. And that's what actually goes through an insurance company complex into an investment portfolio. So, I mean, clearly insurance companies are actually sort of have a great business model and they've got consistent flows of capital. I think what's actually happening is that capital actually has a relatively low cost of funds compared to basically other forms of private capital origination, you know, in our space. But it is regulated, and it has to come into the market through, you know, probably, you know, very targeted strategies. I mean, my simple experience around insurance company flows into our space is really targeted towards, you know, more of the lending side. I mean, loans in just the pure loan form tend to fit the regulatory sort of regime of insurance company investment programs better than, you know, structured credit, which have sort of idiosyncrasies to them that get a little bit harder for insurance companies to basically take significant exposure to. So it does tend to lean a little bit more into what I described earlier with your first question, is more of the lending form versus the taking basically a participation in either the funding or the credit risk through a structured credit transaction.
Sticking on the theme on the institutional investor side, do allocator motivations differ, say, between insurers, pensions, sovereign wealth funds, like when it comes to these markets? How do you guys see that, balance with, the various LPs that invest in 400 Capital, for example?
Yeah, I think it's I mean it's kind of a big question because the simple answer is it takes so many different forms. You know, the like I said, I think one of the common threads is whether it's insurance, you know, it's a pension endowment foundation, it could be basically, you know, the wealth channel. Everybody loves diversification, and
Yeah.
you know, as I mentioned, really the exposure to corporate credit is super high because it's the most evolved in terms of a credit sector. So it's not surprising that it's most portfolios have a lot of corporate credit exposure. Asset-based credit is appealing because it's a great diversifier. You know, the credit cycles in the asset-based markets are really driven by just the ability to repay debt, and the ability to repay debt in the corporate market is driven very, very much alongside GDP. It's very correlated to GDP. The you know, housing related credit It will follow GDP to a certain degree. It's going to follow certain nuances of employment also.
Yeah.
Um, and then there's a different regulatory regime around housing finance credit. Commercial real estate. I mean, just look at what's happening in commercial real estate. Just you don't have to go far from the newspaper to find out that commercial real estate has a lot of very idiosyncratic issues, and we're not in a recession.
Yeah.
That's a function of sort of COVID in certain subsectors or the rate cycle, which actually really dramatically changed the cost of funds in commercial real estate finance. So what we love to talk about with our investor partners is that what's attractive about the asset-based space and in corporate space included in that broad credit space is the underlying subsectors all basically rotate through their cycles in different phases. So if you're a manager that has the view of all of them and has the sort of the ability and the disciplines to sort of do, objective relative value and has the ability to rotate portfolios actively, you can kind of really always find opportunities if you basically are able to basically, identify those phases appropriately and do the active rotation.
Going back to the managers, do you see a bifurcation between emerging between managers who are able to deliver true alpha and those that are kind of claiming to?
Um, I guess like my simple answer is I'm gonna borrow a quote from one of my colleagues. You know, he always says that I'm just going to use this hypothetically is you get paid a call it a mid to high single digits return if you basically lend a balance sheet. And that's kind of the asset-based finance or the direct lending concept. You can get paid a double digit return if you solve somebody's problem. And so solving a problem may be answering the question, hey, I'm a fintech. I came out with a new financial widget, but I need financing and I can't get it from a bank. So
Hmm.
I'm in the private markets. Will you solve that problem? And we love that problem. We're a day one investor in a lot of spaces. We pride ourselves on it. It takes a lot of work. You have to have a lot of knowledge over time about what you see and what works and what doesn't work. And then you have to know how to basically negotiate and contain the risks with something that actually might be an emerging, financial product. The other one is regulatory capital issues, which is really kind of the core of what we've started the business around. Is that like I said, Fannie and Freddie are classic examples of that. Treasury just said we're not going to take the credit risk. You got to distribute it into the private credit markets, or the U.S. and the European banks do different forms of regulatory capital friendly securitizations, or what's now sort of evolved or is now referred to as SRT.
Yep.
And so if you're actually solving like a regulatory capital issue for a financial institution, primarily a bank, usually you're going to be in a more junior part of the capital structure to achieve that. And that does require a different expertise than just lending. And that's where you can get a double digit return on just the investment before applying any sort of portfolio leverage to it. So, that's the way we kind of break up the world when we think about it. We tend to, from our point of view at Foreign Capital, we tend to lean into the later. I mean, we view ourselves as problem solvers, and we, view that you can actually really get, back to your point. We think that's identifiable alpha because you're actually solving a problem, and you're getting paid an incremental return. That's not just a levered lending solution. You're getting paid something over and above that, and I think the way you also test that is, managers that do that, you got to look through and sort of challenge them on their loss ratios. Anybody could take structurally levered risk and say, oh, I'll take your regulatory capital issue off your hands. But if they can't price it or manage it appropriately, you'll see it in the loss ratios. And so like being able
Mhm.
to do that and actually keep your loss ratios very low actually sort of just proves that you're actually truly you're capturing the alpha.
So I wanted to move to a couple of things that have been in the news recently. That is one is Tricolor. or tricolor, as many people would refer to them as. I believe it's
Sure.
tricolor. And then First Brands, obviously, both have been big stories in the news, and they're both now obviously in the distressed situation. How would you view the current state of distressed structured credit and the ABS markets, and any kind of further thoughts on kind of what's happened with either one of those brands, which have obviously taken up a lot of attention these days?
Yeah, I think I mean, the simple answer is they're episodic, and I think, mostly reflective of the fact that, it's one of the things you get paid for is you have to basically, do your work, and you have to know where to say no, and you have to certain, constraints about how you source, um, opportunities broadly across the space. Now, I mean, Tricolor is still basically sort of working its way through like its resolution, but elements of fraud, obviously, just by definition, are not necessarily easy to basically detect, and they will catch basically people off base. So I don't mean to basically be hypocritical or contradict myself with regards to that when elements of fraud are involved. But I do think like you again, I hate to say, like, it kind of reflects the sort of like um the older guy in me, is that when you're around long enough, I mean, you kind of have seen a lot of finance companies. I worked at Bank of America for a long time, and we lent to everybody. And so when you build basically sort of that experience of I saw all the subprime originators. I've seen all this, mortgage originators pre-financial crisis. We knew, some of the most aggressive, structured credit players. We just you kind of get a sense for like, all right, well, what kind of like platform makes sense for us. Um, we've kind of mostly tried to intentionally steer the business that we do towards more institutional related platforms. Um, if we're going to do something, like I said earlier, that's going to be day one, we would prefer to do it with an operating platform that actually has demonstrated that it could actually create new financial products, and they're just doing an extension of that. But they have a sort of a good track record with regards to an operating platform. Um, but in the same case, Tricolor, it was not like they popped up overnight. And then there is just certain elements about like how fast their growth intentions are. Those things are just things that you have to pay attention to. Um, there is ongoing, due diligence and surveillance, and you can't just rely on administrators or servicers. You kind of have to also just be willing, especially if you're going to take levered risk to those types of platforms. You have to be willing to basically do ongoing sort of management and surveillance. And so it takes work. It's not a cheap endeavor if you're going to be in those spaces. I can't say that would eliminate all the problems, but I
Yeah.
think that's somewhat of it's going to highlight and it's going to separate sort of managers in the space that sort of are willing to do that. Not every manager is going to avoid every risk. So again, like I said, I don't want to be
Of course.
hypocritical, but I do think like as the space, as I said, has come into focus, it seems like there's a lot of capital looking to get diversified into the asset-based finance markets. These are types of um, events that in some ways I think will actually start to differentiate managers that have the disciplines around sort of how to select origination partners and certain credits that they pursue. You're not going to avoid all of those, like I said again, but
Funny, you kind of were stealing my next question, which is in some ways like, can incidents like this, in be healthy for the market, because it might identify some of the risk that's maybe, if it's getting overheated, like people are looking for things too quickly, maybe people are not doing as close due diligence. Instead of it becoming a systemic risk, you have two incidents that happen that maybe kind of dial back people a little bit. Like it in some ways it becomes healthy, though obviously there's some pain associated with both incidents. it's better than if it happened 2 years from now with like 30 different platforms versus, two today.
Yeah, for sure. There's a guy that actually spoke about this a long time ago by the name of Darwin. But it's yeah, I'm actually, I'm always constructive on the markets and the opportunities. I do think they're sort of they evolve, and I think investors, what doesn't kill you makes you stronger. So everybody learns, their case studies, and they're like, again, this goes back to that experience theme that I keep actually leaning on. Is that, if you have basically a really deep Rolodex of these types of case studies, those frameworks start to build, um, and around them, markets tend to basically, correct, and things will actually get done a little more judiciously. If anything, it also sort of reminds people that you can't be too concentrated in particular names or subsectors either.
Yeah.
It does lean into some of the bigger shops too, where that can actually afford to basically build portfolios that are highly diversified. I mean, First Brand seems to be a much bigger and more broadly distributed credit issue in the markets. But again, like if you look at like just the levered loan markets and CLO markets, at individual CLO levels, it's on the smaller side. There's that market has diversified that risk quite considerably.
Yep.
So there are things that actually the market has adapted from previous experiences to be able to contain and manage through those risks.
You've mentioned a little bit earlier, the commercial real estate, opportunities. Kind of where are you seeing the biggest potential and maybe even the most mispriced risk within the commercial real estate space?
We've I think in the current market, we really speak very deliberately about the difference between newly originated loans and newly originated credit, and what I would call just very generically legacy credit.
Hmm.
Commercial real estate debt or loans that were originated, let's say, pre-COVID, to make it very simple. You could even say even in the early 20s, like pre-rate cycle, and so one of the things that's become very apparent is that you obviously have you have some pretty obvious events. You have COVID, which really sort of challenged the purpose for office, and for a short period of time, the utility function of hotels, until the economy kicked back in, and then the rate cycle kind of just exacerbated the issues, and added some challenges to refinancing that the markets are still dealing with more broadly, not only just in office. And then on top of that, you have banks that actually are the primary sort of interface for large loan lending in commercial real estate, but they have regulatory capital constraints, so they can't just warehouse real estate loans infinitely. So they still have to rely on the capital markets. So anyways, the simple way to frame the thesis is that the real estate markets still need basically capital. The banks are the primary face of providing that capital, but they do need risk-sharing partners. They need funding partners too, so they need partners up and down the capital structure. And so we've basically chosen to be in sort of like the risk-sharing part of that market. So we work with the banks and have focused on basically taking risk retention participations in CMBS deals, which are known as B pieces, or risk retention deal participations in single asset, single borrower deals known as SASB, primarily because everything that I mentioned has created an environment where the risk taker has a tremendous amount of say and control over how loans are originated. And that's really unique. Been around the space for a long time. I really haven't seen an environment where a risk taker, an indirect lender like ourselves, can actually really basically work with the bank and say, well, we think actually there should be more equity in that loan, or that loan should have certain reserves, or we think, certain covenants should be basically sort of embedded in the loan documents. And if they're not, we're not going to fund the loan. And that's that what we call pool shaping or credit risk shaping is an incredibly powerful tool. And there's
Yeah.
not that many people in the real estate debt markets that actually have that expertise. They have the relationships with the street. And so it's a relatively, I'd say, not low comp, but it's there's a relatively small group of players that can do that. So you don't have the very competitive pricing markets that really are compressing yield premiums. So you get very attractive yields, and you get a lot of control over the way the credit risk is originated and shaped. So we really like that market. If I framed it appropriately, everybody's familiar with what's happening with what we would call legacy, particularly around office, and there are challenges. Our view is that they've been slow to emerge. The banks have been well enough capitalized that they haven't been forced to necessarily push out a lot of non-performing loans in any significant scale. Every once in a while, you'll hear of a few, but our view is that they're probably going to be slow to emerge. We participate in the NPL market, so we do see a small pickup in that happening, and so we think the legacy loans that need recapitalization or have significant structural issues with regards to tenancy, that's an emerging opportunity. And again, you have to be positioned to actually have the workout teams, the capabilities to basically address that non-performing loans out of the market, but it's still emerging. It's probably going to take a couple cycles before it fully works itself out.
Yeah, it feels like a couple of years ago, right after COVID, there was certainly a lot more alarm bells around commercial real estate. It feels like some of that has faded a little bit. At least the flashing red light alarm bells. And it seems to at least subsided a little bit. And there was also a lot of talk around the regional banks that held a lot of commercial real estate paper and what that might look like. But it feels like from what you're saying, and at least from the outside looking in, like some of that is at least slowly beginning to resolve over time.
Yeah, it's the markets hate the unknown, and
Yeah.
with early stages, it was hard to frame exactly where the problems were, where they concentrated. It became a bank issue around Silicon Valley, because people realized, like, they had that moment, the oh blank moment, and everybody's like, well, how much does exposure is there out there? And it forced everybody to start to identify, where the pockets of concentration were. It seemed to resolve itself, or at least people understood it. It seemed to be capitalized and at least getting reserved for reasonably well. Now that the banks have actually sort of, I think, are getting to a point where they're getting to reserves that they can afford to actually do transactions, that's where I see marginal pickup in NPL activity, where the banks are like, okay, we can afford to actually move some of this off balance sheet. So that's why I think you'll see a little bit of a pickup. My other point is, I think people now are actually understanding a couple elements. Is like I said, the risks are identifiable and they're mostly underwritable. You can basically sort of get a reasonable feel in different markets about how bad occupancy can go,
Hmm.
or what the alternative use is. That's the big issue. That's always sort of, real estate 101 is, if things go bad, what's the alternative use?
Yeah.
Um, and retail's been dealing with that for a while. Like you've seen, malls, there's an alternative use that they've turned it into, which has become very popular. And it's keeping the mall alive. And then there's what's becoming truly exciting is like markets like New York. People recognize there are housing issues. There's definitely a dearth of
Yeah.
available affordable residential housing, and so, like, you're seeing some of these older office buildings actually get competently converted into residential real estate. It's pretty fascinating. It's not easy. It's expensive.
Yeah.
Technically, it's very hard. But there are a few players that are actually capable of doing it. And so the alternative use for like office is starting to emerge in certain markets. So like I said, it's becoming easier to underwrite than it had been in the past.
One final question before we move to the fun questions, and then wrap up in a few short minutes. If you look ahead, say the next 12, 24 months, are there any themes or structural shifts that you think will define structured credit investing, over the next couple of years?
The one theme that you have to pay attention to, which uh, has been very interesting to see how whether it emerges as a challenge to the sector, is regulation. And again, this just goes back to like a historical perspective. Is in the early 2000s, regulation around sort of the finance industry in general, and particularly in consumer finance, was very light. And you could just see that like the lending disciplines, just it was just chasing. Everyone was chasing into a black hole, and it created the issues that sort of eventually materialized in the great financial crisis. So one of the things that I've been pleasantly surprised with, but it's kind of something that we always have to pay attention on. You can't get complacent on is are there still good lending disciplines around sort of new credit formation, and is it regulated well? The markets can regulate themselves to a certain degree, and like you pointed out, First Brands, Tricolore, are going to actually be examples of like where the market's going to learn and they'll probably adapt. But markets historically don't regulate themselves that well. They're still economic beasts. So you do have to kind of look and say like, is there still basically sort of good lending discipline still, at the bank level, to create the discipline, and it hasn't been foregone such that some form of systemic risk starts to creep in. Those are some of the really big trends that I kind of try to pay pretty close attention to.
So we have
sorry, just add one last comment.
Yeah, no, go for it.
Obviously, just when you get, and this is one of the things that goes back to the first question you said, is like when you get like new forms of capital, or you get a lot of capital that comes in, and it basically it's a race to the bottom with regards to cost of funds, and the market just starts competing on a cost of funds basis, and capital's coming in kind of, almost without any reservation. It's you got to pay attention to sort of just risk taking on the margin also. So like, does risk discipline start to erode? So those are kind of some big trends that I do think that we pay attention to. But on the positive side, I do think that the structured finance, the asset-based finance markets, they're evolving very favorably in terms of becoming a much better and well understood asset class. The investors are becoming more sophisticated. I'm walking into meetings where I don't have to do any education. I felt like I was just educating people all the time. So the investors are becoming educated on the market. So I do think it's actually going to continue to become a growing market, with the right disciplines around it. And I think like the institutional exposure particularly is going to continue to grow into the asset class.
So just a few fun questions as we get wrapped up here. Do you have a favorite sports team and/or hobby?
I do have a favorite sports team. It would be the New York Rangers, and so it's my local team. It's my favorite sport to watch. I tend to have the privilege to get to know a couple of the players, some around, a lot of hockey junkies, so to speak. So I'm very optimistic that we're gonna put the right team on the ice this year. So I'm looking forward to my Rangers games.
Well, it looks like you guys have had a good start this year, I believe, right? The first couple of games.
It's getting there. It's getting there. It's very early. Let's just put it that way. It's a very long season, so
yes, it is.
I'm very cautious judging the season. Other than being an optimist, it's a little too early. And then I picked up a hobby not too long ago. I love playing guitar, so that's become my other
Oh,
my other
nice.
hobby. So we've got
Well,
Rocktoberfest coming up. My plug for an event that's coming up in the city this week. So if people want to pay attention to Rocktoberfest, I'm going to do a cameo with some friends in a band, and it gives me a chance to combine everything that I really love doing.
nice. Well, I would ask one surprising thing about yourself, but I think that probably answers that question as well, unless you have something else surprising.
No, that would be it.
What would be one book you'd recommend reading?
uh, uh, well, I always tell people you should read two books. It's kind of, I guess it's a little bit, I should be a little bit more creative and a little bit more humanitarian, but I always like, from my point of view, I always say you should read Liar's Poker and The Big Short. Obviously Michael Lewis books. And from my point of view is like, for everything we just talked about, Liar's Poker is the front end of everything we just
Yeah.
discussed. You know, it was kind of when investment banks were private partnerships, and they kind of ruled the roost back in the late 80s. And then you had the Big Short, which obviously was really framing the great financial crisis and many of the things that just went sideways and wrong. And if you put the two books together, there's actually at the very back of The Big Short, Michael Lewis actually, obviously used to work at Salomon Brothers, which I actually used to work at Salomon Brothers too. So I actually completely appreciate the environment and why he chose to go take John Goodfriend out to lunch. And so everybody tries to put their finger on what was the catalyst for the financial crisis. And I love the end of that, because it pulls basically the beginning and the end of the whole story together. Is John Goodfriend says it was really when Salomon went public, and he goes, basically the risk was then basically transferred to really anonymous source versus the partners. And so he always viewed that as basically sort of the initial trend that basically sort of set off the elements, which over a couple decades took time to materialize and ended up just basically misaligning risk and return. And so I find that's fascinating, because I think one of the things that actually keeps really good risk discipline is when you have an alignment of incentives. And so when
Yeah.
risk taking is aligned with capital, you usually get good results. When you separate the two, you can get very dangerous situations, which I think sort of the pair of those books highlight.
Most exciting part of your job?
You guys, well, I love meeting clients. That's without a doubt. You get to meet amazingly smart, fascinating people. They come from all walks of life. They have all sorts of educational backgrounds, different perspectives on the markets. I always tell everybody in my firm, I try to turn it into a two-way dialogue. I think there's a virtual cycle in terms of basically going out and meeting investors, because the questions they ask you are reflective of probably the environment that they're in. So you can learn a lot if you actually pay attention to the type of questions they ask you, versus just basically sort of speaking out on your expertise or basically the market that you may be basically sort of discussing. So I think that's a privilege, to basically just meet with a wide range of investors. I always learn a lot. I think if you don't do it, you're really shortchanging yourself in terms of just really truly staying connected to the markets.
Well, Chris, I really appreciate you coming on the show. I think it's been a fascinating and interesting conversation. So thank you for your time, and continued good wishes and luck to your Rangers, and obviously to you in the firm.
Yeah, Todd, it was a pleasure. Appreciate it. I had a lot of fun.
All right, thank you.
Thanks.
Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.